Okay, good morning. We'll start. So, last class, wherever we ended, next credit risk, we have completed that one. Now we'll move over to operational risk. So, what is operational risk? We have to see what is operational risk in the bank and how the capital is to be calculated. So, operational risk means what? Operational risk means that risk which brings in the loss due to these things: failed internal processes, failed failure due to people processes, and failure due to system, or from the impact of any external events which are not under our control. External event means any of the physical disasters like earthquake, flood, fire, like that, any external events which are beyond our control. So basically, operational risk is due to this failure in the internal processes, or fraud by the people, or people intentionally or unintentionally do something for which loss is suffered, or due to failure or mishap in the systems, any kind of loss which happens. Those losses are such type of losses which cannot be estimated. You cannot calculate or estimate those kind of loss. So that's why they fall under the category of operational risk. So for them also, bank has to be prepared to cover those losses by allocating capital under operational risk. That is the purpose of operational risk. Okay. Now, that's why, since it cannot be assessed or estimated, so the scope of this operational risk is very, very wide. So you cannot estimate, you cannot pinpoint an amount that this might be happening. So the calculation of operational risk is totally a what you can call it. It is not exact actually. Whatever Basel prescribes, it is not the exact amount you can predict that this much loss will happen. But it has been decided that if you can carry this one, so we can cover the operational risk. Okay. For this purpose, there are three methods or approaches under operational risk. So first approach is basic indicator approach. First approach is basic indicator approach. Second approach is standardized approach. The third approach is called advanced measurement approach. Earlier I have told you all these three things. So Indian banks and banks in India, they are under these two approaches. AMA approach is not yet, this is yet to be complied with by the Indian banks. Okay, but these two are done. Basic indicator approach is completed or compiled, compliance is been done by all the banks. So all the banks have moved to standardized approach. And the calculation of capital for these two approaches are almost same. But the calculation for AMA is totally different. So first we'll discuss about this basic indicator approach and standardized approach. For these two approaches, the first thing what is required is we have to take the gross income of the bank. What is the gross income of the bank has to be calculated, has to be obtained for 3 years. For the past 3 years. Past 3 years, subject to the fact that in those 3 years, the bank must have profits. If there is, bank has shown any year there is a loss, that year should be excluded. So loss, if any loss is shown by the bank for any year, that year should be excluded. You have to go back to next year where the profit is happened. So 3 consecutive years your profit has happened. For those 3 years, you have to calculate the gross income. That is the first step. First step is find the gross incomes for the past 3 years where bank has earned profits. If there is any loss in any year, those years should be excluded. Second, average it. Average the gross income. Means 3 years gross income is found out. Add 3 divided by 3. So that becomes our average. Next is multiply this average amount, average gross income with a factor. With a factor which is prescribed by Basel. So for this factor are alpha for basic indicator approach, beta for standard idea. So this is the process. You have to take out the gross income for the past 3 years where bank has earned profits. If there are any loss in between, those years should be excluded. Then make the average of the 3 years gross income. Multiply this average gross income amount with a factor called alpha or beta to get the capital, which equals to capital. Okay, this is the steps I have told you. Now, we'll see what is this gross income. What is this? How we will arrive at gross income? If gross income is already given, there is no problem in the question or something. Gross income, simply you take the 3 years and multiply it, divide it by 3. But sometimes questions will be asked where gross income is not given. You will be given with a position called net profit. Net profit and other details will be given. So you have to find out what is the gross profit or gross income. So gross income, nothing but gross profit. So from net profit, you have to arrive at gross profit. So to arrive at gross profit, some adjustments are to be made, plus or minus whatever. Because see, in salary, when we get salary, we know that every month we get net salary. Net salary is after deduction, addition, whatever it may be from the gross salary. So some adjustments are made with the gross salary to arrive at the net salary. Okay, so that means suppose gross salary is this much. So gross salary was say 40,000 and net salary say 31,000. That means there is some adjustment where some deductions have been made. So when net salary and other deductions, whatever is made, it is given to arrive at gross salary, what you have to do? Those deductions which are made, we have to add back. Add back those deductions with the net salary to arrive this. So there are certain things, similarly, there are certain things, if net profit is given, certain plus or minus has to be made to the net salary, to the net profit to arrive at the gross income. So what are the adjustment? Just you have to remember those. So what are those adjustments you see? Okay. Basically, these are the adjustment. So gross income means, normally it means the net interest income plus net non-interest income. And if they are given, then fine. Otherwise, net profit is given. Then remember, provision and contingency has to be added, because to arrive at from gross profit, provisions and contingency are deducted to arrive at net profit. So when it was deducted, we have to add it. Similarly, operating expenses are deducted, so we have to add it back. Okay. Next, there are some deductions or addition which are to be done as per RBI. So this deduction or additions, next 4 are compulsory in nature. So profit on sale of HTM investment. So bank might have some investment made in HTM category where the sale has been done, and for that sale either a profit is made or loss is made. So when profit is made and it is already there in our net profit, that has to be deducted. If loss has been made, then loss has to be added back. Okay. Now, any income which has been already there in the net profit thing, that if that pertains to insurance income, whether it is a fee from insurance or insurance claim has been lost and insurance claim has been received by one, those things has to be deducted. And any extraordinary or irregular income means these two are insurance income and extraordinary or irregular income. We can tell that these are not the income from banking transaction. They do not pertain to banking transaction. They are totally different types of incomes. Say extraordinary or irregular income means any legal issues is happened where bank has gone to the court and after some time bank has won the case and some money has been paid by the counterparty. So that is not a banking income. Or it might be possible that bank might have sold some of the fixed asset. Some of the fixed asset and some proceeds are credited to P&L account. So that is not a banking income. So if such items are there, then definitely those to be excluded. Yes, insurance, I told you, insurance means any insurance claim which bank has lost, insurance claim. Insurance claim in the sense, these are general insurance claim, not those DICGC insurance. DICGC and other type of insurance we claim for loan account, they are credited into loan account only. They are not credited to P&L account. So any insurance claim which has been credited to P&L account, that has to be deducted. Whether it is insurance fee by selling bank insurance or any insurance claim has been made on any property or anything where bank has received, that is credited to P&L account. So those things are true. So basically these are the entries in the profit and loss account which has been made. So you have to remember this one. This addition has to be made because provision and contingency or any kind of write-ups are there. Those has to be reversed back. Okay. Operating expenses has to be also reversed back or plus. Then loss has to be added. Profit, loss on the STM, sale of STM administrator to be added. Profit on sale of STM had to be deducted. Okay. So apart from some other adjustments are there also, but that is not necessary because question will be asked on this. So first step is what? Look out for the last 3 consecutive years where the bank has made profits, and for those years you find out the gross income by excluding the years where bank has shown the losses. Okay, then take those last 3 years gross incomes, sum it, then average it by dividing 3, and with that amount multiply the alpha or beta. Okay, so this alpha for the first basic indicator approach, basic indicator alpha is our 15%. This is constant. So average of gross income to be multiplied with 15% for basic indicator approach. But for standardized approach, the beta is, there are 3 betas. Instead of 1 factor, betas are 3. So it is 12%, 15%, and 18%. 3 are there, and they have to applied to different gross income we have arrived. I just did. I hope this is clear how to arrive at gross income and how to arrive at capital for basic indicator approach. Okay? Any question? You can ask me now. Otherwise, I'll move to the next approach.
Sir, Sir, if there will be loss for 1 year, we will take the average of only 2 years?
No, 3 years. You have to go back. You have to go back. Suppose 2017, 18, 19, 20, 21, and 22. Okay?
Yes, sir.
Suppose 22, you have a profit.
Yes.
Here loss was there. Here loss was there. Here profit. Here loss was there. Here profit. That means 3 consecutive profit you have to take. So loss to be excluded. You exclude the losses. So you have to take these 3.
Okay, sir. Thank you, sir.
Sir,
Hmm.
in the case of standardized approach, if beta is given 3% now, that 15, 12,
Okay.
which one we will take, sir?
I'll just explain. I will explain where this 12 will take and where 15 and where 18. Okay. Because in basic indicator, so there is no bifurcation of gross income. Only one gross income we are taking and multiplying by 15. Okay, but that 15 has been in the standardized method 12, 15, and 18. It is. If you average it again, it comes to 15 only. Yes, if you average it, it comes to 15 only. But due to some relaxation and other thing, 12% and 15%, 18% has been divided by differentiating the incomes. The incomes have been differentiated. There are different, I'll just tell you. So that in next slide it is there. So what is that? I'll tell you. For that purpose, our bank's entire income, our bank's business has been divided into 8 business lines. There are 8 business lines. So these are the business lines: corporate finance, sales trading, retail banking, commercial banking, payment settlement, agency service, asset management, and retail brokers. These are the different business lines which has been identified by the bank. And what are the activities here they have prescribed? Which are the activities coming under what type of business line? So in the standardized approach, what has to be done? The same process of finding gross income, but gross income has to be differentiated into each business line. So you have to see the gross income has to be for all the business lines segregated separately. So what is the amount of gross income for say corporate finance? So say whatever amount is, you have to see. So for a gross income, when you divide all these 6 or 8 things and you put together, that will be year 1. Year 1's total this much, but you have to bifurcate this way. And out of this all the thing, some business lines have been assigned with 12%, some have been assigned with 15%, and some with 18%. In the next slide, I will show you. Okay. So according to that, these are the 3 business lines which has the beta of 12%. Those are retail brokerage, and asset management. Then commercial banking and agency services have 15%. Corporate finance, trading, sales, payment, settlement has 18%. So for 12% you calculate the capital. With 15% calculate the next capital. So suppose this is C1 and we arrive at CA2 by multiplying these 2 with 15%, then C3. So total capital under standardized approach of operational risks will be C1 plus C2 plus C3. Is it clear? So do not worry about this. In the examination, they will provide you the list with this 12%, 15%, 18% also. But basic indicator approach, alpha will not be provided. Any doubt? I'm waiting for your doubt. Any doubt is there? You ask me.
No, sir.
No. Okay, fine. So you know the process how to calculate under basic indicator approach and how to calculate standard error. Now the third method is advanced measurement method. So basically this is a totally different method than these 2 methods. You have to forego all these things to arrive at the capital for advanced measurement method. So here basically what is here normally what is the calculation? Calculation is to find out what is the expected loss under operational risk. So basically the approach says that you have to find what might be the maximum potential expected loss under operational risk. And if you can find that, then that much of capital that will be the amount of capital to be maintained by the bank to cover that loss. So suppose we expected that 90 rupees will be our loss. So basically 90 rupees is the amount of capital we have to do. So this is the process where the calculation of expected loss are made, or they are measured by through different, taking into account different factors like internal loss data, external loss data, scenario analysis, and business environment and internal control factors. So different factors are to be taken. Those factors I am going to tell you. And another thing is very important for this operation risk, where risk mitigation is allowed in operational risk, because risk mitigation for operational risk is a process which can be done through insurance only. So risk mitigation up to 20% is allowed under this process. So why I'm telling you, sometimes MCQ is asked, what is the maximum percentage of risk mitigation allowed under operational risk? So you can say it is 20%. Or a question will be asked, what is the process of risk mitigation in operational risk? Then you can say insurance is the process through which mitigation of operational risk can be done. Okay. Now we'll see what are those, how these factors or this internally generated measures can be calculated, and finally we arrive at expected loss. So basically the process is, first we have to arrive at a probability of occurrence. So bank has to arrive at this probability of occurrence. Means we have in the credit risk, I think you remember, probability of default, PD, LGD, EAD. We have already discussed that one. So probability of default we have already discussed for the credit risk. So this is somewhat equivalent to that same thing. Whatever the probability of default was there in credit risk, same thing is called probability of occurrence. Means this is calculated based on historical frequency of events or occurrences, and from this the likelihood of the future occurrence or future happening is calculated or estimated by the bank. Means suppose last 10 years historical frequency, say 5 years, last 5 years, bank has taken some data that in last 5 years in India there was, say, only very small, say, what you can call. So if you take the earthquake, so there is no major earthquake has happened which is actually, which has created damages to the building or anything in India. Okay, so we can say that those occurrences or which has happened, they are very, very minor in nature, and it is not at all damaged. And if at all damaged, then that damage is very, very less. So we can say that in 5-year period, suppose as per yearly, if you take, so it was happening maybe every 2 years once it has happened. So every 2 years once has happened means it is 50%. So we can say that 5-year period, if 2-year period once has happened, so 5-year period, how many times it will happen? Same thing, we can say that we can plot it that if the minimum is once in 2 years, so we can say that it is 50%. So we can say 50%, or this can be represented as a risk score also, either percentage or risk score. Risk score in the sense you can give the number 1, 2, 3, 4, 5 like this. You can give so that 1 will be the lowest one and 5 might be the highest score. Okay, so either you give percentage or you can give risk score according to those type of loss which might be happening based on the historical frequency of events which has already happened. Similarly, earthquake or fire or any other event or system failure or fraud made by the employees, fraud by the outsiders, hacking of system, whatever it may be. So those things we can say that if that is the case we have taken estimated, so in future also this is the minimum which might happen. So that's why you will take that one. Second is if it happens, then what will be the financial impact? What will be financial impact? Financial impact is nothing but amount of loss. So this is based on the potential of historical impact of amount of loss due to historical impact we have already assessed whatever the occurrence will be. So expected amount of loss can be estimated. So that amount can also be represented by percentage or by risk score. Just like probability of occurrence, you can also give a percentage or simply a risk score number like probability of occurrence. Okay, next one is this is impact of internal control. So what is to face these challenges of operational risk? What are the internal control of systems and procedures the bank has already made available? So that is the internal impact of internal control. Means suppose it is based on the logic. How this will be done. This is again a percentage. This is done with it is a score of percentage. How it is calculated? It is based on the logic that if bank can control the likelihood of happening of any event. Now, suppose this control is there. So through this control, bank can prevent the losses of any such operational risk events. Then in the future also, bank can manage or control or mitigate the similar kind of operational risk. Suppose today a bank has estimated that our internal control can prevent, say, 50% of the unusual thing that might happen. So I can say that this bank's internal impact of internal control is 50%. That means if I continue with this internal control in future also, my internal control will be 50%. But if I know that something better I can improve this internal control, then also I can prevent the losses due to such things much better. So based on that, I can also increase that internal control thing. Okay, so it is important to assess what is the present internal control impact of the internal control, so that what will be the strategy of the bank in future, whether it can control more than that or it is continuing to controlling the same percent. Okay, but it is very difficult for a bank to say that I can control 100%. It is impossible. So worldwide, Basel has given a basic cap on this, that this impact of internal control cannot exceed 70%. Because only 100% will be applicable under emergency time or exigency time. It is possible that people can have that much of control. Otherwise, in normal condition of banking, no bank can go beyond 70%. So basically, IIC is never exceeding, it is never exceeding 70%. Okay, and this is given. So basically, that should be given by the bank. So this PO, probable occurrence or PFI, can be represented with a risk score 1 to 5, or it can be represented a percentage also. That is the one. Now, if we can arrive at these things, so basically, the calculation of estimated level of loss due to operational risk is square root of this thing. Square root of multiplied by square root of probability of occurrence into PFI, that is potential of financial impact, into 1 minus internal control, impact of internal control. This is the formula. Suppose probable occurrence is 2, PFI is 4, IIC is 50%. Then we can easily calculate PO is 2, PFI is 4, II is 50%, means 1 minus 0.50 equal to 8 into 0.5, so equal to 4 equal to 2. So our estimate loss level might be 2. 2 is low. Or if it is, you can give the percentage or amount is given. Suppose probability occurrence will be given as number, say 2. PFI is given as say we can say it is 4 crore. And IIC is 50%. So PFI can be given as the amount also. So in that case, what happened? Our loss will be 2 crore. We can say there might be 2 crore of loss. Is it clear? This formula has to be applied. That's all. You know, PO, probable occurrence, and PFI will be given, IIC will be given. Just multiply all the thing and take the square root of that. So that becomes our estimated level of loss due to operational risk. Any question? Otherwise, we'll move to next one. No question?
No.
Okay. Now we'll move to capital charge for market risk. So credit risk over, operational risk over. Now we'll move to market risk capital. Now we have already, I've told you why capital of market risk is important. Because in market risk means it is totally our bank's investment portfolio. Investment portfolio means banks always invest some of the part of money due to compulsion or due to surplus in some kind of securities. So basically they are invested in securities. Securities can be shares, security can be bonds, securities can be debentures or any other instrument which is available for investment. And these securities are such securities which has a market value, means it has got a price and it has got a rate of interest where market rate is there. So this price may vary due to movement of rate of interest in the market. So due to adverse movement of rate of interest, the price may vary. So when the price comes down, then only loss happens. If price goes up, loss might not happen. So to cover the loss, bank has to maintain market risk. And this has to be done on a continuous basis or on a daily basis. So daily basis procedure of market risk, where I was discussing this trading book, what was the term applied for this daily basis adjustment of P&L? Can somebody tell me? Daily basis when it is compensated to?
Mark to market.
Very good. So that process was called mark to market process. So when we are adjusting or the compensation of loss or gain to the P&L is happening daily basis, that is called mark to market. Same concept is applicable for maintenance of capital. As we are compensating the gain or losses to P&L, we have to calculate the capital for the losses. When gain is there, there is no nothing to be calculated, because in a day there might be losses, there might be gain. So total loss and gain, whatever we have to net, whether it is a total gain or total loss, that we have to see. If total net is say positive, that is, this is credited to the P&L. If it is negative, it is debited to the P&L. Similarly, if it is positive, no need to maintain capital. But when it is negative, we have to calculate the capital. So that is also done on a mark-to-market basis. Every day, whatever the losses, net loss is there, on that capital has to be calculated. Okay? So basically, as I told you, it is required for compensating the abnormal losses which may arise on account of adverse movement of market prices of any of the security where bank has invested. That is the basis. And this happens, as I told you, that this may happen for two more reasons. So first reason is adverse movement in the interest rate. So first, that rate of interest of the market may move adversely. So due to movement of rate of interest of the market, or rate of interest, I can say, the price may come down, for which we may have losses. Second thing, that it may also happen due to adverse change in the factors related to the individual issuer. So basically, as I told you, these are the security. Security means many shares or debentures or bonds which are issued by some other concern. Maybe a government has issued, maybe a corporate has issued, maybe another bank has issued. So means for all these shares, debenture, bonds, there has to be an issuer. So bank has invested in that. And it is possible that one of the issuer, if say a corporate issuer, so corporate issuers, suddenly what happens, your bank is invested and suddenly it happens that corporate who has issued these securities, his credit rating has fallen considerably during the year. So whenever credit rating falls, means the credit worthiness of this corporate has gone down. So automatically this will have a sentimental thing for the market, and automatically what happens, the market value of the security will also fall down. Okay, similarly, suppose this corporate, suddenly it is found that this corporate had taken some loan, big loan from the banks or financial institution, and they could not pay the installment, so it has turned NPA. So NPA means, again, when it turns NPA means credit rating will fall immediately, and immediately market value will fall. So those are the different factors which are not part of rate of interest, but other factors which may reduce the market value of the security, and those factors are related to the individual issues. Okay, so one factor is rate of interest, second is related to issuers. So there might be two factors which are responsible to bring down the market value, for which, or market price of the security, for which bank will face the loss. So why I am telling you, because for these two related things, two types of capital has to be calculated. For this, one type of capital has to be calculated. For this is to another type of capital has to be calculated, and total of these two capital is the market risk capital. Okay, now what are they called? So basically, as I told this already, I have told you, banks are required to manage the market risk in the book on an ongoing basis and ensure that capital required for market risks are maintained on a continuous basis. That is, at the close of each business day, or that same concept, mark-to-market concept, has to be followed for calculation of market risk. Okay. Now we'll see that What are the capital charges calculated? Two capital charges. So basically two things. So when the capital is calculated due to the movement in the interest rate. So first concept I told you, the rate of interest in the market. For that, whatever capital we calculate, that is called general market risk capital. Simple thing. You should remember. Some questions are coming. How many types of capital are calculated for market risk? So you can say two types of capital. And sometimes told what is the purpose of calculating general market risk? General market risk is that amount of capital which is calculated to cover the losses due to movement in the interest rates of in the market. So whenever when it pertains to rate of interest or movement of rate of interest, and that capital is called general market risk. General market risk capital. When it pertains to the factors relating to individual issuer, the second one, issuer related, that capital is called specific market risk capital. So both has to be calculated. When you add together, this is the total market risk capital. Clear? So we know that there are two types of capital. Now we'll see how this specific is calculated. Specific type of risk, the specific risk pertains to the issuer. So they depend on the first thing, that definitely issuer or any factor related to issuer which may result in movement of the price or market value, or basically downgrading the price or market value of security, and what type of security they have issued, whether it's a bond, whether it is share, or whether any other instrument like debenture or any other debt security instrument bank has invested, and also with the remaining maturity of the security. This we know. This is we see from the time band, we can see that how many years left, that is called remaining maturity. Okay, so based on this, the specific risk capital can be calculated. So the capital charge or calculation of capital varies from 0 to 100% based on the above parameters. So how much will be calculated, that will vary from 0 to 100%. And capital charge for various investments are prescribed by RBI in their guidelines for market risk. So for each type of instrument, so this is the type of instrument, second or type of security, type of instrument. RBI has prescribed also type of instrument you see, and time band will be there. So type of instrument, time band will be there. According to that, some say constant, say we can say this maturities which are called say modified duration or sensitivity. What is the rate of it? So that rate has been prescribed by RBI according to the type of security and time band. Based on that, this type of security of this time band will have this type of sensitivity. So percentage will be there or VAR is there. So according to that, you have to multiply those things with the rate which is prescribed by RBI to find out the capital required. So that is a complicated method. We are not going to discuss that one. We will discuss only for general market risk, where the questions are coming for the last 2-3 years. It is coming. So we will discuss about that. Now we'll see what is the calculation of capital for general market risk. General market risk, as I told you, it is calculated under the standardized duration method. This is the second approach. First approach was standardized maturity method. So both are almost same. Only thing why second method is preferred, because the second method, duration method, gives more precise or more exact, or you can say more accurate result than this maturity method. Okay, that's why the standardized duration method is followed. That is the only thing. Now, what is the calculation? Calculation of capital is modified duration of security So if modified duration is given, then that's fine. Otherwise, if max duration is given, then you have to find out what is the modified duration multiplied by market value of the current market value of the security multiplied assumes change in the yield. So what assumes change in the yield? So this assumed change in the yield is given by RBI. This is given by RBI for each type of security you are having, type of security and time band also. This assumed change is given. So when you multiply this modified duration of the security with market value and whatever the assumed change related to it, then you get the capital. Okay, so this is what so assumed change is given by RBI or regulator, which varies from 60 to 100 basis point. So basically, it will vary from 60. So 0.6 to 0.1 basis point, it is varying. So depending on the remaining maturity of it. So there is a big list where assumed change is given. So you have to find out the modified duration. You know the market value of security today. So you calculate that one, multiply this and find the capital. That is the process for calculation of this general market risk. Any question you ask me right now, because we are going to another step which is much more complicated. So I will advise, if it is digestible, understandable, then you go for it. Otherwise, simple thing, you just ignore it. Do not break your head if it is not understandable. If you are understanding up to this, then I can go ahead to describe those things. Yes or no?
Yes, sir.
Okay. Up to this, you have understood how this capital charge for general market risk is calculated. You understood, because this is not complete. This is the formula I have told you, but there are some more adjustments has to be done for this. And that question is coming for the last 2 years, last 1 or 2 or 3 seasons is coming. And last time the question asked under this carried 5 marks. 5 marks with 2-3 answers you have to give. So 5-mark question is asked. So I will just explain to this. You focus on that. If you can understand what I am going to tell you, it will be very difficult to understand at the first instance. So if you can understand 50% of that, then fine, good. Because if you understood 50% right now while I am explaining, then you can read it in the Macmillan book. Go and read the Macmillan book, you can understand 100%. That is possible. So do not worry about it when I am explaining. If you can understand 50%, tonight you read the book and you can easily understand the full concept, and you can score 5 marks if this is coming. And it is described in page 238 of Macmillan book. Okay, so write it down, page number 238, Macmillan book, it is described. So I'll go ahead with the description. Okay, now what is the process? How this process is to be done? So the total capital requirement is arrived at as below. Okay, so it is under standardized duration method. So first we have to find the modified duration, as I told you. So calculate the price sensitivity or modified duration of the each security. So you find the modified duration. Then you know the market value. Already market value is known. So modified duration you have to calculate, or if it is there already, you take. Then apply the assumed change in the yield to the modified duration of each security, which is between 60 to 100% depending on the maturity of security as prescribed by RBI. So there is a assigned this assumed change in the yield has been given by RBI. So I apply that. So we have market value with us. We multiply with modified duration. Then we multiply with the change in the yield. Change in the yield percentage as per the RBI prescription. Okay. Now, whatever the capital we have arrived, say we have arrived at a capital, say 200. Then this capital, what we have arrived, this next step is this one. Slot the resulting capital into a maturity ladder with 15 time bands as prescribed by RBI. So we are calculating this for individual securities. This is security 1, security 2, like this. Suppose 100 securities are there. We have calculated all types of security and we have also find out where they belong. And RBI has, for this purpose, has prescribed 15 time bands. Time bands means they are the residual maturity period. Okay. Now, before I go to that next one, so you have to just fit into which slot it is there, which time band it is happening. That you have to find out. Next is long position and short positions has to be found out. So can you tell me what is a long position and short position? What is long position and what is short position? Maybe in your treasury class, it might have been told you. What is a long position and what is a short position?
Overbought and oversold position, sir.
Okay. Long position is oversold or overbought?
Sir, overbought.
Overbought. Over.
So what happens normally? Why it is overbought? Why some bank will buy more?
Because in
Yes.
expecting future, the price,
Yes.
share price will be more.
Very good, very good. So that is the expectation that bank can gain due to long positions. So there is a sentiment in the market, or you know that if I can have this for another 6 or 7 days, there might be a increase in the market value or market rate of this thing. So market value of the security will be increased. So bank may gain. So basically for that purpose, this position is called long position. So basically we can say that long position are a positive position in our trading book. In the trading book, all these market securities are accounted for. So normally it's a positive position in the trading book. And this oversold position, normally it is a negative position in the trading book. Bank has sold or might have oversold the securities for which bank has a negative position in our trading book. So that position is short. So currently, RBI does not allow short position for all kinds of security. It is not allowed. Only for two things RBI allows short position in India. So first is for derivatives. If bank is having some derivatives, it is allowed. Second is any government securities. So all the government securities or derivatives, you can have a short position. But other than that, short positions are not allowed. Okay. So at the end of the day, when you net, so basically we are netting the long or short positions. Long and short position has to be netted to find out what is the net position. And basically, whenever there will be a position in the derivative or government security, then only this short thing will happen. So basically the thing is that whenever short positions are there, that is a negative position. So basically capital is required, because for positive position, capital is not that much important. Only when short position is there, we have to cover with that with the capital. Capital has to be carried out for that one. So whenever a position is given where there are 2-3 positions where long position and short position both are given, in such cases, after calculating the first calculation, we have calculated this market value multiplied by modified duration multiplied by yield change. We have calculated this one. and this capital is calculated. Suppose calculated is 200 crore. And we see that at the end of the day, there are certain long and short positions are there. There is a short position due to derivatives and government securities. So in such cases, further adjustment to this capital has to be done. So further adjustments are to be done. Those two adjustments are called vertical disallowance and horizontal disallowance. So two adjustments are to be made. One is called vertical disallowance, one is called horizontal disallowance. So basically, why this vertical disallowance is done? Vertical disallowance is to be calculated or to be adjusted or to be made to cover the basis risk. Basically, this is to cover further basis risk. If there is basic risk, then that has to be covered. So for that, vertical disallowance has to be. Horizontal disallowance is to be calculated to cover the yield curve risk. So you remember these two. Vertical disallowance is for basis risk. Horizontal disallowance for yield curve risk. Okay, so two more further adjustments has to be done. So we have to find out. So originally we have calculated 200 as capital. Now we have to add what is the vertical disallowance. Suppose this is X and this we have at Y. With this capital you have to calculate this. So total capital will be 200 plus X plus Y. So that will be our total capital for general market risk. This is the process. Now for that, as I told you earlier, long position, short position. So those securities might be, I'm erasing this one. The securities might be all securities, whatever security they are invested, they have a time band. The time band is nothing but this is the remaining maturity of the security. So the RBI has prescribed 15 different time bands. So you have to place those long position and short position of each security into different time bands. Different time bands. Say there are some securities of long, short will be there, different time bands. So when the time bands are long or short position of that security are certain securities are in long position and certain securities are short position, and they belong to the same time band. When they are under same time band, whether it is between long or short or long short, whatever, if they fall into same time band, then vertical disallowance is allowed, is to be done. And vertical disallowance is currently 5%. Simply, you calculate the 5% of that capital, netted amount of capital, because long position capital was say 100 rupees. So it is a plus 100. And short position capital was say 20 rupees. So net position will be how much? Net position is plus 80. So on this netted position, we have to calculate the vertical disallowance at 5%. So how much it will be? It will be 4. So total capital, whatever we have calculated, we have to add this 4 with that one. So for same time band, vertical disallowance has to be applied. When this next, after doing this vertical time band, wherever same time bands are applicable, then we go for different time bands. Then we'll go for different. It is between different time bands where this horizontal disallowance will be applicable. For that, these time bands, 15 time bands are there. And these time bands are divided into 3 zones again. Zone 1, Zone 2, Zone 3. I will show you the table how this is done. So these time bands are divided into 3 zones. And horizontal disallowance are calculated for different time band. They are not under same time band. Okay. So first you have to see if at all they fall under same time band. So there might be two bifurcation for this zone. So it can be for same zone or it can be for interzone. Same zone means two time bands might be there, zone 1. So if they fall under that, a separate percentage. There might be possible that it might be between Z1 and Z2. So this is a interzone. Say it might be Z2 to Z3. It is another interzone. It might be Z3 to Z1. So for that, different rate is applicable. Okay. So same time band you have to see. Time band is the remaining maturity of the security. आपने suppose somebody has done a fixed deposit here with the bank. Suppose he has done a fixed deposit for on 1st of January 2022, which is maturing on 31st of December 2022. Okay. So this is done for a period of 1 year. Or suppose 1/1/2022 it is maturing. So this is done for 1 year. Now today is say 4th of October. Now how many days are left or how many months are left? From today, what is the maturity date? What will be the maturity date? So in October, we have already 3 days gone. So today is 4th. Means we have 27 days. November, 30 days. December, 31 days. So there are 88 days remaining. So time band is 88 days for this fixed deposit on today. So every day time band will change. Time band as on 1/1 it was 1 year. Now time band has changed to 88 days. Is it clear?
Yes, sir.
Okay. Time band means what is the remaining maturity of the security. We are looking at a security, particular security. How many days left for to the maturity date? That is called time band. So there are 15 time bands given by RBI. Okay. So according to that, this article, I can explain that one again. So just see, these are the time band. So time bands are 15 time band. So first time band, this is called zone 1, this is zone 2, this is zone 3. In first time band, there are first zone, there are 4 time bands. Second zone, there are 3 time bands. Third zone has got 8 time bands. So total you have 15 time bands. Time bands are residual maturity or remaining maturity of the security. Okay. Now, if the long position, short position of the securities are available where they fall under the same time zone, same time band. If they are under same time band, means a security long position is for 1 to 3 months, short position is also 1 to 3 months. Then what horizontal disallowance will be applicable for 40%. Simple thing. You have to find out the time band. If it is matching and it is between same time band, then this percentage will be there. If it is within the same time band of zone 2, 30% will be the vertical disallowance. If it is happening within the zone 3, then 30% has to be applicable. And this is applicable when the time band is within the same zone. Okay. Now, as I told you, it can happen between zone 1 and zone 2. So this is one security and this is one security. So there is no matching within the zone. So next one will be the interzone. So zone 1 and zone 2, if the adjustment is there, then this will be 40% adjustment. If this is happening between zone 2 and zone 3, then also 40%. If it is happening between zone 3 and zone 1, which are the farthest zone. So nearest zone 40%, 40%. Farthest zone, that is zone 3 to zone 1 or zone 1, zone 3, then that will be 100%. Okay. So basically what first I have done.
So these things that we have to remember all these time band zones.
No, they will be given. So normally it will be given. It will be given. Okay, so basically it will be given. So otherwise you just remember up to 1 year is the zone 1. Sometimes if it is not given, up to 1 year is zone 1. Up to 3.6 year is, so more than 1 year to 3.6 is the zone 2. Above 3.6 is zone 3. So you can relate it which time zone they are falling. So remember that 1, 3.6, that's all. First is up to 1, second is up to 3.6, next is more than 3.6 up to 20 years or more than, say, up to 30 years securities are also available. So more than 3.6 years, whatever is that, those will be zone 3. Okay. So this what we have done. First step was find out the positions you are holding long or short in the same time band. First, you have to see whether same time band, if some positions are held. If that is there, then we have to vertical disallowance has to be made for this same time band. So if it is happening for same time band, vertical disallowance has to be done. Second, we have done for different time bands. Different time bands. And this is horizontal disallowance. And this is as per this table. So first you have to see this, whether there are same time band available. Apply this 5% vertical disallowance. Keep it aside. Then find whether different time bands are there. Apply this horizontal disallowance. Whatever the amount comes, add those things. Add it to the original capital we have calculated as per the market risk, general market risk capital. Okay, now I'll just give an example. So this is the example. Say long position in security with remaining maturity. This is a time band. Okay, this is a 2-year maturity. 100 crore. Market risk capital 100 crore. This is also a long position. This is long position. This is long position. Maturity of 5 years. 450 crores of capital. Short position due to derivatives with remaining maturity of 6 months. 100 crore. Short position, 2 years, general market 50 crores. Okay. Now, what is the first thing we have to do here? I have told you first step is, what is the first step? What is the first step for calculation? Just earlier slide I have written.
Modify
duration.
Modify duration.
Start with the price sensitivity.
Same time.
Yes. First, we have to see for this calculation. These are not required because already market risk capital has been calculated. So you forget about that modified duration, market value. That is not required, but because already those have been calculated, we have also arrived at those things. Now we have to see only vertical and horizontal disallowance. So first I told you to find out any positions there if they are under same maturity or some remaining time band. Whether you find anything? Do you find anything under same time band?
Yes, sir.
A and D.
A and D are
Red
in the
and
vertical.
So very good. So A and D are the with same time band. So A and D, we have to apply what? What is the application to be done for A and D? Vertical. And this whatever disallowance we are allowing, this is for the netted position of the capital what we are having. Netted position, that amount would be applicable. So what is the netted position of A and D will be?
50 crore.
50 crore, because netted position is, first one is 100 plus, because it's a long position, and D is the short position, so it will be 50 minus, so netted position is 50 only. So on this 50, that 5% is applicable. Vertical disallowance is 5%. So in this portfolio, we see that position A and position D are within same time band. So we take those things because this is 2 years, this is 2 years. The rest two are of different time band. So the vertical allowance is applicable for position A and D. So it will be 5% of the netted amount. So netted amount becomes 50 crore. So 5% of 50 crore equal to 2.5 crore. So vertical allowance we have arrived at 2.5 crore. Clear? So first step is done. Next step is to find out which is the lowest maturity band in this position. Which one is the lowest one?
C.
C. Very good. C is the lowest one. So first step we have done this for second. Second step, find out the lowest maturity band among the rest position. So position C is the with 6 months maturity. And it is a short position or long position? It is a
Short position.
Short position of 100. Okay. Now this should be netted to the next nearest time band which is available. Next nearest time band is which one?
D.
Up to
Next time band A and D. So 2 years. So 2 years already we have netted. So what is the netted position we have arrived?
2.5.
No, netted position. I'm not talking about capital.
50.
Netted
50
position.
crore.
50. So that 50 we have arrived. So here we'll see this should be whatever the lowest one should be netted against the next nearest time band available. Here next time band available is 2 years. For the 2-year time band we have already netted the same, which has now a long position of 50 crore. Okay, so this was a long position of 50 crore because long was 100, short was 50. So we have a long position of 50. Now we have to net it. So how much is coming? Again, it comes to 50 crore. Short position of 50 crore. Okay, so this position of C belongs to which band? Time zone. Zone 1, zone 2 or zone 3?
Zone 1.
Zone 1. So this belongs to zone 1. Okay. Now this 2 year belong to whether zone 1 or zone 2?
Zone 2, sir.
Zone 3.
Zone 2, sir.
Zone 2. Zone.
Sure, na? This belongs to zone 2. So now this horizontal allowance will be between zone 1 and zone 2. So what is the percentage for that?
40%.
40%.
So 50 crore, 40% is how much?
20 crore.
20 crore. So this horizontal allowance we have done with the lowest maturity with the next nearest one. Oh, okay. Now, after netting this thing, the net position remains how much? How much it is remaining? This is minus 50, right?
Yes, sir.
Now minus 50 remains? Yes or no? Because we have
Yes, sir. Yes.
here minus 100 was there, we have netted plus 50 from earlier one, so it is minus 50. And this minus 50 to be netted against next available time band. So what is the next available time band? This is the next available
5 years.
5-year position, which is the position of B.
Zone 3.
Okay. So 450 minus 50. So what is the position now? 400. You have to net this one 50 with the 450 first. So this is 400. Yes. So this 400, which is the last band we are doing. So this 400 should tally with our total net of this algebraic sum of the position. So algebraic sum is how much? 100, 450, both are plus. Then minus 100, minus 50. So you tell whether this cancels. 450, 50. So 400. So this is tallying with this one. So this is correct. Our netting is correct. So you have to see that whether the last netting is correct with our algebraic sum of the capital we have done. Okay. So this matches with the algebraic sum. So there is no position, no problem at all. We are doing correctly. Okay. So now this netted amount, what is the netted amount? Netted amount. This here we have to see the netted amount. Here not the, always we are looking at the netted amount, whatever netted amount is there. So netted amount is 50. And now we see in which zones they belong.
Zone,
Zone 3, sir.
zone 3, sir.
Zone 3 and 1.
400.
Zone 1 and zone 3. And for this zone 1 and zone 3, what is the rate?
40% and 30%.
100%.
No,
100%.
100%.
100.
When it is for zone 1, 3, it is 100. Okay. So that means how much capital is required? 50 crore. Okay. So third step we have done. This is also 50 into 100. So it is 50 crore. So total of vertical allowance and horizontal allowance, how much? 50 plus 20 plus 2.50. So it becomes 70 to 50. Okay. Earlier position we have carried out, this is 400. So total capital becomes 470 to 50 crore. So this is the capital required for this. So the capital charge for general market risk equal to algebraic sum of the general market risk we have taken here, because 100, 450, 150, algebraic sum becomes 400 plus vertical disallowance we have arrived at 2.50 plus horizontal disallowance we have arrived at 70. So total becomes 470.50. Okay.
So this is 472 for both vertical and horizontal disallowances for capital, sir.
This is total capital under general market risk with vertical and horizontal adjustment.
Okay,
Vertical
sir.
allowance
without horizontal and vertical disallowance, how to calculate, sir?
So this is the algebraic sum. Whatever the positions you are having, because these short positions are to be adjusted or netted against the long position. So though you are maintaining, actual capital required is this 400 only, because long position is plus 100, this plus 450, short position 100. So this is minus 100, this is 50. So when we sum it together, we get 400. Actually, this 400 is the requirement. Due to short positions, we have carried those things. Those should be offset with the long position. So normally we are carrying, because this will be gone. Losses will be totally covered with 150. But these are not losses. For profits, you are also maintaining. So 550 minus 150 becomes 400. So 400 is your capital for general market is we are maintaining. Along with, you have to calculate this vertical disallowance and this horizontal disallowance, add that one. So we can say that our total capital required is 470 to 50 for this purpose. So a total question comes like this, it will have 5 marks.
So I
My
missed
question
this.
is,
Sir, one more question, sir.
Pardon?
Sir, one more
So
question.
there's one question. Sir, when we shifted to the last position, that is zone 1 and zone 3, could you please explain this, how this 50 came before, after 400, you went to step 3, zone 1 and zone 3, and this 50 into 100% I understood, but 50 after 400 you calculate.
So 50 we have, so that 50 comes from the carryover. What was the earlier one? Carryover was 50, na?
Yeah.
So that carryover has to be, because that carryover is the negative one. So that carryover is 50. So we have to calculate that disallowance for that carryover only, not the under 450, not under 450. Okay. So always remember that will be under the netted position, which is the lowest one. Lowest netted position has to be taken into consideration.
Okay.
Any other question?
sir, my question is how to calculate general market risk for without vertical and horizontal disallowances.
So that I have given you formula, na? I give capital equal to market value of the security multiplied by a modified duration of security into assumed change of yield. I have given this. The slide was there. No? This is the capital you are calculating. All these 50 crore, 800 crore, 450 crore, 100 crore, they have been calculated under this market value of the security multiplied modified duration of the security into assumed yield change of the security, which is given by RBI. So you multiply these things, you will calculate the general risk, general market risk capital. After that, we have to add this vertical and horizontal allowance if there is short positions available.
Sir, one more question. Sir, in second step, why we are taking 6 months with long position only? Why not with short position of 2 years, sir?
No. I have not taken short position. I have taken the netted position.
Okay,
2
sir.
years, which is netted position taken. 2 years both are there. So netted position I have taken. Netted position I have taken. This 50 was netted, na?
Okay, got it.
So this 50 I have taken the net position. It is not about the long or short position.
Short position.
Always take the net position. Whatever position is there, then net. If that is not there, then I would have taken long position only. If short position 2 is not there.
Got it. Thank you. Thank you, sir.
Okay. Next one. I discussed 3 more chapters. Another 10 minutes might be 10 or 15 minutes required. Okay. So next one chapter is called Altman Z score or Altman G score. So this is sometimes normally one question is expected. So we have almost covered our risk management. So what is the purpose of risk management? Can you tell me? What is the main purpose? Risk management focuses on what?
Sir, how we can manage our risks?
Mitigate the risk.
Mitigate the risks, sir.
Mitigate risk capital.
Okay, I got it. But yes, very good. So all things pointing to capital only.
Yes, sir. To how much cushion we can maintain with our capital.
Yes, very good. So whatever we are doing, entire management process of risk, everything pertains to maintenance of the minimum capital. Okay, so why you are maintaining this capital? What is the one word result? One word you can say that capital is to
save us from the resultant
sustain the business.
Not sustain the business, to save us from
resultant losses, sir.
Bankruptcy.
Very good. So we can call to save us from bankruptcy. That is the only word I was just expecting. So whatever you are telling that is correct, but more correct is that entire risk management is focused on maintenance of capital, and capital is maintained to prevent us from bankruptcy. Because bankruptcy is the only calamity nobody wants as a businessman. Any business, they do not want to face this bankruptcy or winding up or liquidation. Okay, so is there a method where anybody can do any statistical thing where this bankruptcy can be predicted? That is a question. There are so many things available. It is like astrology. Astrologer, you go and they can predict whether that is true or not. That is immaterial. But certain times are there when you fall into some kind of problem, everything, you have no option. You go to astrologer or anybody else. So they will see your hand or head or leg, whatever it may be. They give some prediction which according to your satisfaction. You do this, that, it will happen. Okay, so same thing, question arise. Every businessman who does business, they do not like this bankruptcy. So is there a method of calculating or predicting where the bankruptcy may happen? Or you can say the bankruptcy is, we can say failures. Failures can be predicted or not. So for the last so many years, for 40, 50 years, various calculation metrics are being used by different people, different researchers, different economists to gauge this failure or bankruptcy. However, no concrete findings could be assessed by anyone else. Whatever the metrics they use, they were giving some conflicting results. So it was not possible. So it was done. But in the year 1968, there was a professor named Mr. Edward Altman. He looked at the different types of metrics which he has been using to predict those things. So he developed a model which is called Altman Z-score or Altman Z-score. What he did is that basically he combined all things. After so longer period of research, he could find out that my model is almost 90 to 95% correctly can predict. And he had tested it also. Basically, this model was first invented for manufacturing industry only. So he invented for this, he have prescribed this for manufacturing industry only. Nowadays, this can be applied to any kind of industry. Same model has been modified and this can be used for any kind of industry where you can predict the bankruptcy. So what he did to eliminate the confusion in predicting such kind of mishappenings in future, which is called failure of bankruptcy, Altman has modeled this Altman Z-score by combining 5 very important or vital financial ratios. And these ratios are basically performing or performance financial ratios. So he took five ratios and say those ratios are taken, and for each ratio, he multiplied that ratio with a constant factor. So each ratio was multiplied with a constant factor. Then he added all these 5 to get a number. So finally, a number, a numerical figure is arrived at. And this number, he gave a range where this number is falling. So first range, he gave at the top range, he called it as a safe zone. Second, he called it as a gray zone. And third, he called it distressed zone. So if that number falls under this distressed zone, then he suggests that this company or this institution may go into bankruptcy within a period of 1 year. So that is the prediction of this Altman Z-score. Okay. Is it okay? Did you understand this?
Yes,
so
sir.
that I can go. Okay. Now, how these are done? Basically, his ratio is x1, x2, x3, x4, and x5. Suppose it is taken as x1, x2. So basically, x1 is the working capital to total asset ratio. This gives us the liquidity position of the company or the firm, whatever. Second is x2 is retained earning to total assets. Means by using the total asset, what is the retained earning? Retained earning actually, it depends on how much interest you are paying. So how you are leveraging your debts. If more debt means more loan you have taken in the business, your retained earning will be less. If less loans you take, less interest will be paid. So retained earnings will be more. So it will give a idea of how much you are leveraging your debts. Okay, means whether your borrowings are more or your borrowings are less. So that is the leveraging of borrowing or leveraging of debt. Third is EBIT to total assets. EBIT is earning before interest and tax. So this is basically total asset, out of total asset, how much we are earning. So we can call that this is the return on asset. Fourth one is market value of equity, book value of the liabilities of the company. So this gives us market capitalization. This picks up market capitalization. And fourth one is total sales to total assets. This is nothing but your asset turnover. So these 5 ratios are taken, and these 5 ratios are multiplied with, say, this has to be multiplied with 1.2. This is multiplied by 1.4. This is multiplied by 3.3. This is multiplied by 0.6. This is multiplied by 1. Simple thing. I can show you this. So Z score is x1 multiplied by 1.2, x2 multiplied by 1.4, x3 multiplied by 3.3, x4 multiplied by 0.6, x5 multiplied by 1, and add all these things. So you will get a number. So a number will be arrived at. And this number is divided into 3 zones. So first zone is if the number is less than 181, 1.81, so it will fall under distress zone. Means within a 1 year period, that is a likelihood that the company may go into bankruptcy. Next zone is more than 181, 1.81 to 2.99. So that is a gray zone. Means it is a zone of 50-50. Either it can go into distress zone or it can go to safer zone also. And third one is safe zone. When the score is more than 2.99, it is safe zone. Safe zone means no problem at all, not likely towards the risk of bankruptcy. Clear? So I'll show you. The question will be either given this way, so that for 3 years period, I have taken the data, say 2017, 18, 19 of any concern, where these are the ratios, and these are the values of ratios, and this is the constant we have to multiply with, or it's called weight. So multiplication of x1 with this one, x2 with this one. So I have calculated all the things. For 2017, I have got a result of 3.18. So 3.18 is more than 2.99. So this falls under safe zone. 2018, the result arrived at is 2.71. So this falls under gray zone or 50-50. And the third one, 1.70, this falls under distress zone. So within 1 year, say within 2022, this company may go into bankruptcy. So this way the question might be asked, or questions are coming. What is the range of safe zone under Altman G score? So you can easily ask, what is the range of distress zone? Or they will give this one and tell you that in which year the company might face the bankruptcy. So you have to calculate all the 3 and see that, and tell that 2019 we have seen that the resultant of Z score is 1.70, which is under 1.81. So there is a possibility of bankruptcy. Is it clear? Very
Yes,
simple. No complication. Okay.
Yes, sir.
Last
One question, sir. Sir,
ask.
weight will be given, sir, or we have to remember the weight for
You
each
can
weight?
remember, very good. Normally, see, so many times I have seen that they have given the weight, but it is easy to remember. Say, if you do 2 or 3 problems of Altman G-Man, easily you can remember. Simple thing. First one is 1.2. Next one is just second digit is double, 1.3. Third one, you remember, third one is 3.3.
3.3.
Only fourth one you have to remember, that is 0.6. Last one is 1 only.
Yes.
So by doing 3 or 4 problems, this weight can you it is possible to remember.
Sir,
Huh.
sir, please show me once previous slide, sir. Below 1.8 distress stress.
1.9 is 1.81 to 2.99. Okay. You can take a screenshot now without writing. Screenshot is faster. Okay. So now just three things we have to discuss. Basically, two things are there mainly. One is called liquidity coverage ratio. So this is a new addition in Basel III. So what is this ratio? So this is basically liquidity. So bank has to maintain liquidity so that it can avoid liquidity crisis. Liquidity crisis is liquidity in the sense if you have enough money to handle, you don't have to borrow from the market because borrowing is costly. So the purpose of maintaining this LCR is aimed at promoting the capacity of recovering quickly from the short-term liquidity crisis. Short-term liquidity crisis. So bank has to prepare themselves to overcome this short-term liquidity crisis. Short-term in the sense we are talking about here 1 month or 30 days. So for 30 days, you should have enough liquidity. Because in after 30 days period, you can manage that one. So if you can manage for 30 days, another 30 days will automatically. Okay, so that is the liquidity coverage ratio. Another second ratio is NSFR. Net stable fund ratio. Since LCR pertains to short-term liquidity crisis, this is for long-term. Long-term means normally it is more than 1 year. So this is for within short-term means within 1 year, long-term means more than 1 year. So basically NSFR has been introduced to ensure that banks and financial institutions can prevent the long-term liquidity crisis. So you have to maintain here some funds in liquid manner, which are the liquid funds. And here you have to maintain some stable funds. So that's why it is net stable fund ratio. Okay, this is liquid coverage ratio, so it pertains to liquid funds. So these liquid funds are also called high quality liquid assets. They are called high quality liquid assets, HQLA. Okay, these are the stable funds. Stable funds will be calculated. You have to see those stable funds as per the list, which are the stable funds which can be kept for the bank for a period of 1 year, 2 years, 3 years you are keeping. So for long-term crisis, that will not be a problem. Okay, so basically this, how it will be calculated, you have to calculate according to the HQLA. So you have to maintain that stock of high quality liquid assets with you. So how much you are maintaining, how much you should maintain, which will be to cover the net cash outflow. Means how much you have committed to disburse loans or make maturity payments of some investments or deposits in the next 30 days. So that will be your net cash outflow. You have to calculate the net cash outflow over the next 30 days. Suppose next we have calculated the next net cash outflow at say 100. Now this means as per this, LCR should be maintained equal to or more than 100%. So that means my HQLA should be at least 100 or more than 100. So 100 means I am maintaining 100%. If it is 120 means definitely it is more than that. So 120%. So that means you have to calculate and see what is your net cash outflow for the next 30 days. According to that, you have to maintain that HQLA at least for that period. Okay, sometimes bank fall behind this ratio. Say some bank has achieved this 90. That means it is 90%. So there is a shortfall of 10%. In such case, RBI has told that due to shortfall, you can come to RBI. We will give you loan. To offset the 10% or to maintain that LCR level, you have to come to us to give, will give a loan, and that loan is given under a scheme which is called FALCR, FALLCR, Facility to Avail Liquidity under LCR. So sometimes question comes, what is this FALCR? So you can say that this is a borrowing facility given by or undertaken by different banks to offset the LCR shortage, and this is taken from RBI. So in such situation, whenever there is a shortfall in LCR, RBI has introduced the scheme which is called FALCR, where bank can avail the borrowing facility from RBI to cover the LCR shortages. Okay, here what will happen? Again, when you are taking a loan, securities has to be placed by the bank to the RBI. So basically, the securities to be placed are SLR type of securities. The bank has already invested in SLR. So those SLR securities can be placed to RBI to get the borrowing under FALCR. Okay. So this is a FALCR maximum we can borrow is 15% of the NDTL. So that is the cap this given, 15% of NDTL can be borrowed by the bank under FALCR. So this is about the LCR. Now, what is the high liquidity asset, high quality liquid asset? So these liquid assets are again divided into three categories. So level 1, level 2A and level 2B. Basically level 1 and level 2. So level 2 is again divided into 2A, 2B. Why this division? Because level 1 is the top quality. So there is no haircut for this. So haircut is 0. So if you are maintaining cash of 100 means this value is 100 only you can take. So all these level 1 securities, whatever listed, they have a haircut of 0%. Level 2 are little bit say, weaker in nature. So that's why they do not carry 0% haircut. They carry a haircut of 15%. So these type of securities are there. You have to apply a 15% haircut, then you can take the level 2A. Level 2B type of security, the haircut application is 50%. So these are the different securities where level 1 has 0% haircut, level 2A has 15% haircut, level 2B is 50%. So according to that, you have to see how much you are having what, and the net of everything should be equal to your that formula LCR. So 100% should be minimum 100%. Okay, so that is high quality liquid asset under LCR. Now we'll go to net stable funding ratio. So this is calculated as I told you, these are the stable fund the bank has to maintain. So bank has to have stable, a sufficient stable source of funds in order to mitigate the risk in future, which may arise to long-term funding risk or long-term liquidity risk. So basically it is calculated as ASF divided by RSF. ASF is what is the available, right now what is the amount we are having. So available stable fund, what is the available stable fund with the bank, divided by what is the required stable fund. RSF is required stable fund. So this should be, a percentage should be equal to or more than 100. So either equal to more than 100%. Similarly like LCR. So ASF is what? Available stable funding or investment or whatever fund you are having, available stable fund divided by required stable fund for that long-term period. Then you calculate this one. So this is called required stable funding, or NSFR percentage should be this divided this to 100, which should be more than 100%. Okay. So these are the two things which are the last thing. So we have completed our risk management thing. So by evening, I will share the PPT to Mr. Biju or Sajesh. They will be posting in the group. So we have completed risk management. Next class we'll start with balance sheet management. If any questions are there, any doubt is there, or anything is there, you can post those things in the group, or you can send me directly in my number. I can reply to any of your questions, but do not call me because I may not pick up your call. So WhatsApp, whatever thing you directly ask me, I will be 100% rest assured I will be answering those things. Any question you ask me now? If there is no question, then we'll just close today's class. Thank you very much. We'll see you in our balance.
Sir, can you explain once